Good morning. My name is Leila Niamien and my colleague is Ninive Lemba. Today we are going to explore the article The Market Measure of Carbon Risk and its Impact on the Minimum Variance Portfolio by Roncalli 2021 and his colleague. To do so, we will first present the main issue of the article, the theoretical and empirical frameworks, the main findings, then the limitation, and finally the contribution to shape our understanding. The article focuses on a central issue: how can we effectively measure carbon risk using a market-based risk measure and implement it in the construction of minimum variance portfolio. The authors point out a current challenge. Investors primarily use fundamental metrics such as carbon intensity, which quantifies company direct CO2 emissions. While this approach is useful for assessing environmental impact, it does not fully capture how the market perceives and responds to climate risk. To address this gap, the article introduced the concept of carbon beta. This metric measures the sensitivity of stock prices to carbon risk by considering investor reactions to climate change and transition policies. Essentially, carbon beta provides a market-based perspective on carbon risk. The authors demonstrate how this measure can be used as a part of a model to improve risk assessment and integrate both systemic and carbon risk specific risk into portfolio construction. This innovation supports sustainable finance by helping to address global climate challenges while managing financial risk using minimum variance portfolio. Now I will let Ninive present in depth the theoretical and empirical frameworks.
The first point of the theoretical and empirical framework is measuring the carbon risk. The author presents the CARIMA carbon risk management approach by Gordon and R 2019, and they test alternative approaches to measure the carbon risk. The CARIMA consists in measuring a company carbon risk by using the carbon beta of the stock price. The aim is to quantify how climate risk influences the financial performance of a company or a portfolio. To measure the carbon risk according to the CARIMA, it requires two steps: the development of the Brown-Green score, BGS, and the construction of the Brown-Green BMG factor. The first step, Brown-Green score, BGS. The Brown-Green score, BGS, is an indicator used to classify companies according to their climate profile. Brown for polluting companies and green for those that adopt environmentally friendly practices. The system uses four databases from 2010 to 2016. 55 carbon risk process variables are retained and transformed in dummy variables, then classified in three dimensions: value chain, public perception, and adaptability. At the end, we have the equation of risk courses, which is at the average of the variables it contains and running from 0 to 1. We have the equation of the BGS. And to interpret, we need to know that a YBSG score indicates a brown or polluting company, while a low score indicates a green company. The second step is to build the brown minus green BMG factor. Companies are then grouped into 6 different portfolios based on their size and environmental profile. We have small browns, small green, big green, small neutral, and big neutral. The BMG factors constructions follows the methodology of Farmer and French 1992, and we have the BMG factor return equation here. The third step consists now in estimating the carbon beta. The authors evoke Gordon and I 2019 approach in estimating the carbon beta, but criticize the fact that their model is based on a static approach by assuming that the carbon beta is constant over the period. Yeah, they used a dynamic approach proposed by Roncalli and I 2020, which assumed that the betas are time varying because of the changes in policies or ecological controversy on a field, for example. The equation of to calculate the carbon beta is expressed as we can see. Here we have to know that AIT stands for the monthly return of the stock I at time T. Alpha IT stands for the stock specific returns. Beta MKT stands for the sensitivity of the stock I to the overall market. And beta BMG stands for the carbon beta, which measures the sensitivity of a stock I to the BMG factor. And last, IIT stands for the random error terms. The author then proceed in estimating the carbon beta with the Karima factor and the market factor for the stock of the MSCI World Index from January 2010 to December 2018. Then the second point of the theoretical and empirical framework is the absolute versus relative carbon risk. Yeah, the carbon risk can be analyzed into two different perspectives. We have first the absolute carbon risk and the relative carbon risk, RCR and ACR. The first point, the relative carbon risk. The relative carbon risk is directly measured by the value of the carbon beta of a given stock at a specific moment. We have the equation to compute the relative carbon risk here. The carbon beta, when it's negative, reflects a company which benefits from the energy transition or which is poorly exposed to carbon risk. Conversely, a carbon beta which is positive indicates a company vulnerability to climate regulation or environmental impacts. The majority of investors favor companies with a negative carbon beta because they are perceived as less risky in terms of climate change. However, even an investment portfolio with a negative overall carbon risk may remain exposed to underperformance risk in the event or unexposed outperformance of brand companies. The third point of the theoretical and empirical framework is the integration of the carbon beta into the minimum variance portfolio MVP. The model is intended to account for both the market beta and the carbon beta, considering a portfolio composed of multiple assets. The MVP, minimum variance portfolios, then becomes with the optimization formula that we can see here, where RBMG is the return of the BMG factor and beta BMG is the BMG sensitivity of the carbon beta to the stock I. When the BMG factor is added and as an explanatory variable in the return method, the carbon beta directly influences the weight of the asset in the MVP, the minimum variance portfolio. This means that assets with low or negative beta BMG values are favored because they help reduce the portfolio carbon risk exposure. The second point is the key step, where we need to incorporate carbon constraint. We can incorporate carbon constraint with two different approaches. The first approach consists in incorporating a constraint on the BMG risk factor beta. The maximum, which is the maximum tolerance of the investor to the relative carbon risk. And the second approach is to add a global constraint or the carbon intensity, which stands for the weighted average carbon intensity of the portfolio, WACI+. The minimum variance portfolio here selects stocks with both a low market sensitivity and a negative carbon beta. This allows to reduce the common carbon risk, but not the specific carbon risk, which is circumvented by the WACI constraint. Here, I leave the word to my colleague to present the main findings.
The results of this study reveal several key insights about carbon risk and its measurements. Firstly, the authors demonstrate that fundamental measures such as carbon intensity and market-based measures like carbon beta are complementary, not interchangeable. While carbon beta intensity reflects the direct environmental impact of companies, carbon beta show how markets perceive and value this risk in a financial context. The authors further explore this relationship using Exhibit 6, while plot carbon intensity against carbon beta for companies in 2018. The results show how a positive but weak correlation. This suggests that while companies with higher carbon intensity tend to have a higher carbon beta, carbon intensity alone is insufficient to fully explain how markets respond to climate risk, showing that these two measures capture distinct dimensions of carbon risk. These results highlight that carbon intensity does not fully determine the sensitivity of assets' returns to climate risk, thus requiring joint consideration of both approaches in investment strategies. Secondly, Secondly, the integration of carbon variable through BMG factor make it possible to improve portfolio analysis and refine investment strategies. For example, in Exhibit 2, which is a box plot of the dynamic carbon beta at the end of 2018, we can see sectors such as energy, materials have positive carbon beta. Reflecting increased sensitivity to carbon risk, this indicates a significant exposure of these sectors to the risk linked to the energy transition. Conversely, sectors such as health have a beta carbon median close to zero, reflecting a low sensitivity to the carbon factor. This position these sectors as aligned with the energy transition and less vulnerable to climate pressures. Concerning the Exhibit 4, which is the box plot of the absolute carbon risk at the end of 2018, confirms that the energy and material sectors are the most highly exposed regardless of the direction of the carbon sensitivity. Sectors like healthcare have a lower absolute values, making them less risky option for investors looking for minimizing their exposure to climate risk. These two relative and absolute perspectives offer complementary tools for targeting portfolio management. They make it possible to promote green companies aligned with the energy transition or to drastically reduce exposure to climate risk. Finally, the author emphasized the importance of integrating carbon risk into minimum variance portfolios. This integration is not only feasible but also essential for meeting today's financial and climate challenges. By using carbon beta as the market-based indicators, investors can align their portfolio with ESG objectives and climate transitions while achieving robust financial performance and rigorous risk management. In conclusion, these findings provide valuable insight into the role of carbon risk in investment strategies, highlighting the necessity of combining fundamental and market-based approaches to address global climate challenges effectively. But we can highlight potential limitations, and my colleague Ninive will say more about that.
Yes. Though the articles present powerful tools for integrating carbon risk into investment strategies, its results are limited by several factors. The first factor is the fact that they rely too much on data and methodology. One of the main limitations of the study lies in strong dependence on the quality of the data used to estimate the different measures of carbon risk. Calculation of carbon intensity, CI, and the carbon BMG are based on databases such as the MSCI, COCOS, or CDP, which, although reputable, present disparities in their methodologies. For example, the way carbon emissions are reported or extrapolated can vary from sources to sources, which can lead to inconsistencies in results. In addition, these databases generally focus on large listed companies, leaving aside small and medium-sized companies, which play a key role in certain sectors or regions. This methodological dependence limits the robustness of the conclusions and could introduce bias into portfolio management if the underlying data are incomplete or imprecise. The second limitation is the fact that the market factor can be influenced by the beta BMG. The study assumes that the market factor and the carbon factor are independent or not correlated. However, in a real context, this independence is questionable. Indeed, climate risk and events linked to energy transition, such as new regulation or technological innovation, can have repercussions both on the overall market and on the carbon factor. For example, a carbon tax or an increase in energy costs can simultaneously affect overall market returns and increase the sensitivity of carbon intensive sectors. This interdependence could bias the estimate of carbon beta and compromise their effectiveness or the standalone measure. This could limit the relevance of the approach. The third limitation is the fact that the approach is limited on the carbon risk. Although the integration of carbon risk into investment strategies is an important step toward responsible management, the article focuses exclusively on this type of risk. This leaves aside other important dimensions of climate risk, such as physical risk like floods and fires, and potential opportunities such as green innovation. By focusing only on on carbon beta BMG, the approach risks underestimate the overall impact of climate risk on portfolios. Additionally, other ESG factors, such as environmental governance or strategic commitment to carbon neutrality, could complement this analysis to provide a more holistic view of climate risk. Therefore, although the paper's approach is relevant to managing systemic carbon risk, it overlooks other critical aspects that could influence portfolio performance in the long term. This key limitation highlight the need to complete the approach presented in the article. And my colleague is going to present the contribution to shape our understanding of the accurate strategy toward a sustainable socio-economic system.
We can say that the findings of this article have significantly enriched our understanding of how investment strategies can contribute to a sustainable socio-economic system. First, the idea that fundamental measures and market measures of carbon risk capture distinct but complementary dimension of climate risk shows us the importance of a holistic approach in portfolio management. While carbon intensity measures the direct impact of economic activities of the environment, carbon beta reflect the perception and valuation of this risk by the market. This duality reminds us that effective ESG strategies must combine fundamental and market perspective to align financial goals with climate goals. Then, the integration of carbon risk into minimum variance portfolio illustrates how financial traditional tools can meet climate challenges by using beta as a market indicator. We can not only minimize financial risk, but also encourage the energy transition by favoring companies aligned with climate objectives. This highlights a key dynamic in the way that investors can become catalytic for systemic change by directing capital towards sustainable sectors.
The article also makes us understand that any sustainable investment strategy must include a sectoral component to better manage risks and seize opportunity linked to the energy transition. This reinforces the idea that sustainable finance requires both optimized financial strategy and a reorganization of industrial priorities. Finally, this article helps us understand that sustainable finance is not only about reducing exposure to carbon risk, but also about maximizing the opportunities offered by the energy transition. In conclusion, this article reinforces our conviction that sustainable finance may adopt a multidimensional approach. This includes the use of sophisticated measurement tools, targeted sector management, and strategic integration of ESG objectives to support a more inclusive and resilient socio-economic system.
So today we explore the article of Roncalli and his colleague about measure of carbon risk and its impact on the minimum variance portfolio. Thank you for your attention.
Thank you.